A house in Cleveland, Ohio, purchased for $135,000 by a strawberry picker earning $14,000 a year, with no income verification. That single mortgage, multiplied by millions, would destroy the global economy and cost 8 million Americans their jobs. Pause. But the mortgage wasn't the weapon. The weapon was what Wall Street did with it. Slicing it, packaging it, rating it, AAA, and selling it to pension funds, cities, and banks across the world. This is the story of how the greatest financial machine ever built became the greatest financial bomb ever detonated. To understand the 2008 crash, you need to understand three inventions that Wall Street created in the decades before it. The first was mortgage-backed securities. In the old model, a bank lent you money for a house and held that loan for 30 years. If you defaulted, the bank lost money. So banks were careful about who they lent to. But in the 1980s, investment banks figured out they could bundle thousands of mortgages together, slice them into tranches, and sell them to investors. The bank no longer carried the risk. It just collected fees and moved on to the next loan. The second invention was the credit default swap, essentially insurance on those mortgage bundles. Banks like AIG sold trillions of dollars in these contracts, collecting premiums while betting that housing prices would never fall nationally. They had never fallen before. It seemed like free money. The third invention was the most dangerous, the collateralized debt obligation, or CDO. Wall Street took the riskiest pieces of mortgage bundles, the ones nobody wanted, repackaged them into new bundles, and somehow got credit rating agencies to stamp them AAA. The same agencies were being paid by the banks they were supposed to evaluate. It was like letting students grade their own exams. By 2006, the machine was running at full speed. Mortgage brokers were handing loans to anyone with a pulse. No income checks, no down payments, adjustable rates that would explode in 2 years. They called them ninja loans. No income, no job, no assets. It didn't matter. Every mortgage fed the machine, and the machine fed Wall Street's biggest bonus season in history. The first cracks appeared in early 2007. Subprime borrowers began defaulting as their adjustable rates reset. Housing prices, which had risen 124% since 1997, started falling for the first time in decades. In June 2007, two Bear Stearns hedge funds that had bet heavily on subprime mortgages collapsed overnight. Their combined value went from $20 billion to nearly zero. Wall Street noticed, but convinced itself the damage was contained. It wasn't. By March 2008, Bear Stearns itself was dying. In a single week, clients withdrew $17 billion. The Federal Reserve orchestrated a fire sale to JP Chase at $2 per share, a bank that had been worth $170 per share just 14 months earlier. Then came September 2008. Lehman Brothers, the fourth largest investment bank in America, was drowning in $60 billion of toxic mortgage assets. CEO Dick Fuld spent the weekend of September 13th desperately calling every bank on Wall Street, begging for a rescue. No one answered. Pause. On Monday, September 15th, Lehman Brothers filed for bankruptcy, the largest in American history. $639 billion in assets, gone. The next day, AIG, the insurance giant that had sold those credit default swaps, revealed it couldn't pay its obligations. The company that had insured Wall Street's bets didn't have the money. The Federal Reserve stepped in with an $85 billion emergency loan, eventually ballooning to $182 billion. The dominoes were falling across the globe. Iceland's banking system collapsed entirely. The British government nationalized its largest banks. Stock markets from Tokyo to São Paulo lost trillions. The The United States government responded with the largest financial rescue in history. The Troubled Asset Relief Program pumped $700 billion into failing banks. The Federal Reserve dropped interest rates to essentially zero and began buying toxic assets directly, a program called quantitative easing that would ultimately inject over $4 trillion into the financial system. The banks survived. Every major Wall Street firm that received bailout money eventually paid it back, some at a profit to taxpayers. The executives kept most of their fortunes. Dick Fuld walked away from Lehman's ruins with an estimated $500 million earned over his career. Angelo Mozzolo, the CEO of Countrywide Financial, the company that had pioneered those no-income verification loans, paid a $67 million settlement. He had earned over $400 million. The American people paid a different price. 8.7 million jobs vanished. Nearly 10 million families lost their homes to foreclosure. Retirement savings across the country dropped by an average of 25%. An entire generation delayed buying homes, starting families, and building wealth. Of the thousands of Wall Street executives who built, sold, and profited from the machine that crashed the world economy, exactly one went to prison. Karim Serageldin, a mid-level Credit Suisse trader, served 30 months for hiding bond losses. Everyone above him walked free. The 2008 crisis didn't just reveal a broken financial system. It revealed who the system was built to protect. The banks that were too big to fail in 2008 are bigger today than they were before the crash. The derivatives market that nearly destroyed the global economy has grown from $600 trillion to over $700 trillion. The machine wasn't dismantled, it was repaired, refueled, and restarted. Pause. The only question is whether anyone will recognize the warning signs next time, before the strawberry picker's mortgage becomes everyone's problem again.